Hi, Crystal. Today is Tuesday, the 20th, and I'm going to give you this one couple of chapters I'd like to cover today, and we'll go over what's going to be going on this week as well. Um, this week, we're doing chapters 19 through 23. I'm going to do 19 and 20 today. So we're looking at, again, a lot of accounting terms. Many of these you'll remember from your accounting classes. Cash equivalents, known as liquid assets, basically meaning that they can be turned into cash um, pretty much immediately. Um, Organization needs liquid assets to keep operating monies going, and operating funds are placed in some form of um, uh, cash equivalent as a short-term investment or even a savings account to earn at least a little bit of interest. Never hurts to have something, your money doing something. Sitting in a non-interest bearing account someplace is waste. They're all short-term investments because, but so that you can liquidate them, turn them into cash on immediate notice, and have that. They also should be very low risk, so we don't look at going into the marketplace or whatever. We look at interest-bearing accounts mainly. Cash includes our, excuse me, please, currency, our checking and savings account, anything that's sitting around as petty cash, and anything that is the equivalent of money, like money orders and checks from customers. Cash equivalents are CDs, securities, or money market funds. The FDIC, Federal Deposit Insurance Corporation, promotes that confidence by monitoring and addressing risks to deposit insurance funds. And they do have a guarantee on these things. They do have an effect on they limit the negative effects when some sort of institution fails. But there are limits on those. Checking accounts, savings account, and CDs are insured. FDIC does not insure mutual funds, no matter how you get them, annuities, or stocks, bonds, treasury bonds, or anything like that. The basic responsibility as a governmental guarantor will remain even if they change the organization, rename it, or whatever. Long-term bond is a debt instrument under which a borrower pays interest and principal on specific dates to the holder of the debt. Long-term bonds can be 20 to 30 years. Interest would be paid out throughout the term or life of the bond, and then the principal would be paid off at maturity in that 20 to 30 years. We have municipal bonds, we have mortgage bonds. We have, in terms of municipal bonds, we have the general obligation bonds. In other words, bonds to cover our obligations. We have revenue bonds, which are designed to produce money for the use, and typically they finance capital projects. General obligation bonds are backed by the full faith and credit of the municipality, so they are backed by the taxing authority of that municipality. Municipal bond revenue bonds are secured by revenues from a particular project. These are eligible for and health, not-for-profit healthcare organizations can sometimes issue revenue bonds through a local healthcare financing authority. When would we do that? Well, we would do that if we were really looking to expand, say, a public facility for use by the general public. Mortgage bonds are backed by real estate. And first mortgage holders have first claim to the real property. If there are second bonds issued, the second mortgagee or mortgager, anyway, the second holder will not have a claim until all pledged property is paid off to the first bond holders. These are others. Types of debt instruments, debentures backed by revenues that an organization can earn. They are not secured, so they cannot be paid off until all debts that are senior to them are paid. So it's a different type of debt instrument that probably you'll never see as a part of the work you do. Stocks, we have common stock and preferred stock. Stockholders are investors, whereas bondholders are creditors. The difference is that investors own a piece of the company. Investors can buy and sell that piece. Common stock is what we normally think of when we talk about the stock market. Preferred stock is often issued to people, to special investors. I used to, when I was in the pharmaceutical industry and negotiating contracts and negotiating the purchase of intellectual property and products, part of the deal might be to purchase equity in the company from whom I was getting this property as part of the deal. Part of that was to reduce, quite frankly, to reduce our risk with the product, because there's never a guarantee that a pharmaceutical product will ever hit the market. So the mitigation of the risk was that the company's success could also be a part of our revenue stream. It also gave us an incentive to make sure that we did everything we could to make sure that product hit the market, because that was part of that company's success. So it's an interesting thing to do. We would get preferred stock. Preferred stock is often taken at a higher value and is convertible to common stock by some formula. Common stock, basically, when a company has net income, a portion of that is paid out to the as a stock dividend to the shareholders, and it's paid out proportional to the amount of stock they own. So if a company has, say, 30 million shares of stock outstanding, and you happen to own 1 million shares, and the profit is $30 million that year being paid out to the shareholders, you'll get $1 million. Basically, it's preferred. Preferred is a place where we have preferred stock dividends are often higher, and so they're paid before any common stock dividends. Preferred stocks can be convertible if you structure it that way, so that it can be exchanged for common shares, usually not on a one-for-one basis, usually multiple common shares for each share of preferred stock. That's why you see in stock statements Class A, Class B, Class C shares. These are all classes of preferred stock. So stock ownership can either be privately held or publicly held. Privately held basically means that stock is not available on the open market. So, for instance, when in the pharmaceutical industry or the biotech industry, when a company is started, it generally is not publicly traded. It is privately held by the shareholders and by the founders, possibly the employees, and the initial investors. Usually venture capital companies will own stock. So it's a privately held company. Once it's publicly held, those shares are paid out are then available to be bought and sold on the open stock market. A privately held company is also stock is often referred to as closely held. Public companies are traded on many exchanges. The Amex and the New York Stock Exchange, the NASDAQ also is another stock exchange. So investment indicators, we look at investment indicators as to when we should be making investments. We're looking at a number of factors in the economy, and that is the annual rate of inflation or deflation of the stock, and the gross domestic product, which is basically the goods and services bought and sold in a period of time, usually a year. Inflation and deflation are defined. You know what they are. Inflation, we talked about this before, an increase in the volume of money and credit relative to available goods. And if something is indexed to inflation, like Social Security, like often the retirement benefits that you may have as a result of working a long career, they may be indexed, which means that if the economy goes up, if the inflation in the economy by some basket of goods and services is, say, 1.5% in a year, then you will get a 1.5 increase. We call this a cost of living allowance, or COLA, and that is an increase in these things. Now, Social Security index is, and the government index doesn't take into account a number of things that definitely affect, especially retirees. Inflation in medicine, which is very much higher than the inflation in the rest of the economy. Inflation in the cost of energy and the cost of food are excluded, so it's really a cheat. Deflation is the reverse. It's a contraction. Deflation is not as common, but and we don't like it simply because then the prices in the country or in the market actually begin to fall, and the market means where we buy and sell our own goods. They generally begin to fall. That's nice if we happen to have plenty of money and things then cost less, but that may not always be the case. Gross domestic product is the output of goods and services produced by labor and property in the U.S. or any other country, because gross domestic product applies to every country in the world. Investors watch this because it's a measure of the overall fitness of the economy. If you have any questions on this, these are all definitional terms. You can find them in your chapter as well. So let's move on to chapter 20. Which is loading slowly, yes. Okay, chapter 20 is financial terms, costs and choices, business loans, and financing costs we're going to cover here. It's very common for businesses to negotiate loans. Loans can be short-term, they can be long-term. But anytime you do that, there is a cost that is incurred to you. Okay? Capital is technically a combination of debt and equity. Debt, of course, being what you owe. Equity, what your company is actually worth. Capital structure is the proportion of debt to equity. So the debt equity relationship is this is a technical term. In the healthcare industry, the chief financial officer or CFO is usually going to be working on making the decisions or helping facilitate the decisions about the proportion of debt the organization holds. What you don't want, if your debt exceeds your equity and ability to service that debt, technically that means you're bankrupt. So you have to look into various sources. So what are the sources of capital? Well, you've heard the phrase in your accounting classes about sources and uses of funds. And so usually we have a number of ways of getting capital, and as opposed to selling our goods and services. What we're assuming here is that we need more capital than our sales of goods and services in any one period is going to provide to us. So we can borrow from either institutions or investors. Investors don't have to take common stock, or they don't have to. They can take a proportion of ownership, even in a not-for-profit or privately held company. We can retain our excess revenues and build up the capital we need, but if we need it sooner, then we have to either borrow, or the last choice is, of course, selling equity in the company, ownership, to someone else who is investing in it. The sources here, let's just look at borrowing from a lending institution. Can be short or long term, and short or long term long term generally means a number of years. Short term is a small number of years. It can be anywhere from 1 to 3 years. Or we can borrow from investors if we have a big enough organization and a proper legal structure, which has to be reviewed by the lawyers. We can retain the excess revenues. It just means retaining our operating profits. And the thing to remember is that a nonprofit organization may have some limits on how much it can retain, but if the purpose of that retention is to reinvest in the company, then there are lots of ways to get what we need, unless it's really excessive. We can't build up hundreds of millions of dollars when we're doing this. Again, selling additional interest depends on the legal structure as to whether or not it can do so. Also, it needs to be capitalized with enough stock, enough shares of stock, that you always have a stock reserve, what we call the treasurer's reserve of stock in a company. The costs, well, interests, and basically the costs of actually negotiating the loan. There's always a payment up front. There's costs of analysis, costs of a lot of different things. Interest, we know what interest is. Interest is an amount of money that's based on the outstanding principal or amount of the loan. Loan payments include some principal plus interest on that. Interest expense, it depends on what you negotiate. In a good market, you can negotiate a pretty nice rate. A number of years ago, I think I said this on one of my posts here, discussion posts, in terms of the interest rates. A number of years ago, I was able to purchase a new car, at an interest rate of 1.99%, which was significantly less than I was able to get on my investments. And so I borrowed the money. Made sense. Had that been a higher price, I probably would have paid cash and be done with it. But what we do is we pay off our interest. Amortization tables are usually constructed so that we know what we're paying, so that our payments are level through the period of the loan, say 5 years. So we have 60 payments, and it will add up to more than the amount of the loan, but we pay off interest plus principal. Usually we're paying off at a rate such that we always have some principal being paid with each payment. Otherwise, our loan actually balloons. And in fact, I had some friends in England who one time found themselves at an interest rate on their home that the actual interest was variable, and in fact I've seen this when I've refinanced with a variable rate interest. The interest, the amount of interest earned each month was exceeding the payment. And so we were at a point of negative amortization. In other words, our debt was always going to be growing. So at that point, you need to figure out what you're going to do. But for the most part, you get a fixed, you hope you get a fixed interest loan, and then you pay down principal and interest with your amortization schedule. The amortization schedule that you get, that's required to be provided, tells you each month how much of your interest expense, how much of the payment is interest expense. That interest expense is a business expense, and so it gets written off each year. So that's, well, all right. This is exactly what I just said. So an amortization schedule, say we've got, looks like we've got a 6-year loan here, and the beginning balance at $60,000. Okay, so our payments are level here at just under $2,000 a year, or a period. Obviously, I would guess this is a year. So in this case, we see that in a short-term loan like this, we're going to be paying off a fair bit of interest every month or every period. And if we start with 60,000, we end up, our principal, the first period is $1,392.86. And interest was $600. Remaining principal balance then is the difference between 60,000 and 1,392.86, or 58,607.14. So it goes down every year, remaining principal balance. So our next payment, let's just see, I guess this is just six periods of a much longer loan, because at the end of 6 payment periods, we've only reduced the loan by about $9,000. So we watch this schedule, and it tells us all the time. We always know how much we owe on that loan by simply looking at the amortization schedule. Most of the times, if we can pay it, there's usually an ability to accelerate the payments by paying extra principal. The effect of paying extra principal is to actually cut the amount of interest, and therefore the total payments over the lifetime of the loan, which is something that we used to advise, and I think probably still do. We used to advise advise homeowners to pay off extra every month on their mortgage, and significantly cut the time to pay off. It's a good idea. Okay, loan costs are usually there loan negotiation fees. There's points that you have to pay on the loan, which are related to basically points. 1 point is 1% interest, so you get to pay that as an immediate upfront cost at the time of the closing. Then depends on what those expenses are. They can be current year expenses or they can be spread over several years. Management, this is where management earns their money, is in making the kinds of decisions as to how to obtain capital that's needed. The thing that's in effect here is the long period of time. Long-term loans could be 20 to 30 years. Short-term loans, generally 3 to 5, or even less. You can have lines of credit established for your business, so that if you have a business with a lot of variation month to month in revenue, your line of credit will keep you going so that you can pay your employees and pay your expenses in times when maybe your sales are not or your revenues are not sufficient. But but they also tend to be more expensive. Those are short-term loans, and they tend to be much more expensive in terms of interest rate than long-term loans. These kinds of decisions have a big impact on companies, and so you need to go through a formal approval process. And as a manager, you need to know what that approval process is in making and getting the approval to negotiate these loans. So this was an example here, and I think it's really looking at calculating these things, and I don't think we need to go through it. It's fairly, if we look at this, we can actually figure this out. This period, I don't have the interest rate, but the interest rate here appears to be in each period. Yeah, it looks to be about 0.8%. So it's probably about a 10% loan, 10% per annum loan. We'd have to look here. Again, note that each period, the amount of principal being paid rises a little bit. Not necessarily the same. In fact, it starts to accelerate over time. Here we have a difference of about $12. Here we have a difference of a little over $12. And again, a little bit more than $12 more, etc. So it's going up a little bit each period. And the amount of interest that's being paid each period goes down. So the way these tables are constructed are that, and it usually is done through computers, but it takes a look at the periodic rate. Usually you're going to negotiate a rate of some percentage per annum, and this periodic rate that you're dealing with at that point is is one. Say you've got a multi-year loan at 10%. Each month will be 10/12 of 1% approximately. Actually, it's a little bit less because you got interest on interest, but each month is about 10/12 or 5/6 of 1%. So about 0.083, about 0.83 of a percent. So that will be what you are looking at in terms of each month. So this amount of interest is that monthly rate times the outstanding, the remaining principal balance. And each month it's calculated differently. The tables are set up such that we keep the same payment. And how that's done is when you set up an amortization schedule. You can do it in Excel. And so you set up an amortization schedule and you calculate a total payment. One thing that can be done is calculate a declining balance calculation, and then just figure out the total amount being paid, interest and principal, and then divide that by the total number of payment periods during the time. It's a fairly easy calculation to make using Excel. I wouldn't want to do it myself personally. Okay, so that's what I wanted to say about chapters 20 or 19 and 20. Chapter 21 is going to be about owning versus leasing equipment, creating a business plan, and then chapter 25 will start into some other things. So 23 rather, we'll get into some other things. So we'll get into those on Thursday. We'll go through these chapters in our longer class on Thursday. Meanwhile, I'd like to go back here and just look at the week's work that we need to be doing. Okay, this week's discussion is about how cash is generated and how the organization uses its cash. Okay. No, that's week 4. Sorry, I knew that was wrong because I just looked at it. This week's discussion is about the relationship between mission, vision, and value statements and their importance to strategic planning. Where does this fit when considering the construction of a business plan? I've got my first post is about mission and value, or mission and vision statements, and I'll be writing more about value statements later this week and business plans. So, that's the discussion for this week. Let's look at the assignment for the week. Sources of capital for a for-profit company and then for a not-for-profit company, and then pros and cons of various sources of capital. We just talked about some of those. So, look into those, write that paper. It's supposed to be a 2 to 3 page paper. You also owe me a paper from last week. Please get that in as soon as possible. Then you'll have the usual assessment at the end of the week. And I want you to make sure that you continue to do your daily checkpoints. Anyway, I will then see you on Thursday. When you read this, please send me an email. And the code word today is Sydney, SYDNEY. So send that to me when you do this. And I will talk with you on Thursday. Please get some of this work done. I don't want you to fall behind. So I will talk with you on Thursday.